Four things just happened to Bitcoin in the last 10 days that should have taken this market lower, and every single one of them failed. Michael Saylor's company sold 7,000 Bitcoin during the most illiquid period of the year. The worst self-custody breach in years drained over $150 million directly out of people's cold storage, and Bitcoin literally split in two over the weekend. And not to mention, the Clarity Act died in Washington. Bitcoin didn't fall lower on any of it. In fact, it went up. And there's even more to this. Hedge funds on the CME just flipped net long Bitcoin futures. What on earth does that mean? Well, it means the suits are long Bitcoin, which is not something they typically are. That chart, as you can see, has been red for years, and it structurally should be, because by design, most institutions are short Bitcoin. And guess what? For the first time in a very long time, they went long.
Bitcoin just passed a stress test that, under almost any other market condition, should have ended very differently. A major corporate holder sold thousands of coins. A devastating self-custody breach wiped out more than $150 million. The Bitcoin network itself was thrown into a chain split controversy. And in Washington, the Clarity Act effectively hit another wall. Four separate reasons for investors to panic, and Bitcoin refused to give them the collapse they were expecting. That is what makes Joe Consorti's analysis so interesting. He isn't looking at Bitcoin through the usual lens of blind optimism or reflexive bearishness. He's looking at the market through the behavior of capital, who is actually buying, who is selling, where those coins are moving, what institutions are doing, and how macroeconomic pressure is changing the incentives underneath the price. And his conclusion is much more nuanced than simply saying Bitcoin is bullish or Bitcoin is bearish. Because underneath the headlines, something potentially important is happening. The market absorbed extraordinary selling pressure. ETF demand remained strong. Long-term holders are still sitting comfortably above their cost basis, and perhaps most surprisingly, hedge funds on the CME have flipped net long Bitcoin futures. But Consorti also makes it clear that Bitcoin is not completely out of the woods yet. The question isn't simply whether Bitcoin can survive another piece of bad news. The bigger question is whether the marginal buyer is finally strong enough to take control of this market. And that's exactly where we're going next. We're going to break down the deteriorating labor market, the changing expectations for Federal Reserve policy, the return of the debasement trade, why Bitcoin has lagged gold, and the four shocks that somehow failed to break the market. Then we'll look at what institutional flows and Bitcoin's cost basis data could be telling us about the next phase. If you want more analysis like this, make sure you hit the like button, subscribe to the channel, and turn on post notifications so you don't miss the next video. And let me know in the comments, has Bitcoin finally absorbed the worst of this correction? Or is another major move lower still possible?
The American economy lost 23,000 jobs in July. Wall Street was expecting a gain of 85,000. That is a miss of more than 100,000 jobs in a single print. And it's the third largest monthly job loss since the pandemic in 2020. And it gets worse. The previous 2 months were revised down by 103,000 jobs. So the labor market that everybody thought was doing well in May and June was actually not even holding up in May and June. We just found out late. The unemployment rate actually fell as well, down to 4.1%. Now that sounds like good news until you understand why. You do not get job losses and falling unemployment at the same time unless people are leaving the labor force entirely. Said differently, it's not that people can't find work, it's that people stopped looking for it. And wage growth stalled at just 0.1%, meaning with inflation at 3.5%, you are losing 3.4% of what your wages actually get you every single year. Here's why that jobs combination matters more than any single number you're going to hear over the next several weeks. Going into last Friday, the market had the odds of a rate hike from the Fed in September at 70%. 3 Fed officials even voted to raise rates at the last meeting where they chose to do nothing. Some of the biggest desks on Wall Street were telling clients to expect an increase and to hold off on buying risk assets like stocks and Bitcoin. But by the end of that morning, after the jobs report came out, those odds dropped to 30%. One of the sitting governors at the Federal Reserve, and he even follows me on Twitter, Stephen Myron, said it publicly in plain language. He said that the jobs data showed exactly what he feared, and that we should not be asking people to lose their jobs to offset what is probably a measurement error in the inflation data. So translate that out of central bank English, and it says one thing. The hiking cycle is over. And the Fed is sitting at 3.5% with $40 trillion of federal debt underneath it and over $1 trillion a year in interest payments. There is no version of this where the largest line item in the federal budget gets deliberately more expensive on purpose. So the Fed's not going to raise rates. The market just did what the market always does, and it repriced higher. Gold went first, up 8% in 3 days and up over 10% on the month to $4,400 an ounce. The Nasdaq added $3.5 trillion in 4 sessions, which again is the fastest rally in American stock market history, and the dollar index broke below 100, which by itself is the single largest input into global liquidity, turning back on, but more of that later. Every one of these moves is the exact same trade. It's the debasement trade. In other words, what capital does when it knows that money is about to be printed out of thin air. It is capital saying that the printers are coming back. So the debasement trade woke up across every asset class on Earth, which brings us to the part that has been driving people insane for 10 months. And I think almost everybody is explaining it wrong. Bitcoin didn't participate. Not on Friday, not the week before, not for most of this year, and in fact, not for the last 2 months when Bitcoin has basically spent all of its time at $64,000. Gold has been running for 2 years, but Bitcoin is down more than 50% from its high set last October. Now, there's a version of this argument you've heard 100 times, which is that Bitcoin stopped being digital gold, that the correlation broke, that the thesis failed, and it turned into a high beta tech stock. And for a stretch late last year and into this year, that looked completely correct. Bitcoin was crashing while gold was soaring, and even the high beta tech stocks were rising. So the correlation between gold and stocks fell. In fact, the correlation between Bitcoin and gold fell to the most negative level it has ever recorded. And people wrote their obituaries. They said, yet again, Bitcoin was dead. But look at where the correlation sits today. It's back. And it's not just back, it's all the way back to the era where people were calling it digital gold. The relationship didn't break. It inverted for a few months during the worst of the drawdown, and then it snapped right back to what it always has been, which is a smaller, higher beta asset, meaning it's more sensitive, that lags the moves gold makes and then makes them harder. That's not a broken thesis, that's a lag. And a lag has a mechanism behind it. It just comes down to who the marginal buyer is. Gold's marginal buyer is a central bank, and a central bank does not need permission from anybody to buy gold. It doesn't need a regulatory framework. It doesn't need legal sign-off. It doesn't need to explain itself to a Senate committee. It just buys. But Bitcoin's marginal buyer in 2026 is a regulated institution. An asset manager, a wirehouse, a pension consultant, and a regulated institution is not asking whether Bitcoin works. They settled that question years ago. Bitcoin is clearly seen as valuable. They're asking a completely different question, which is what it costs them politically to be seen holding it. That is why this year has felt the way that it does. In Washington, the Clarity Act just died, at least for now. September 15th is now another deadline on a list of deadlines that we've had before, and the odds of it passing this year have fallen under 20%. The regulatory hostility running out of certain corners of the Senate is not a threat to the Bitcoin network. The network doesn't care. It still produced a block 10 minutes ago, and it's going to produce another one 10 minutes from now, entirely indifferent to whether Congress ever votes. But it absolutely is a threat to capital formation, to the marginal buyer of Bitcoin actually buying Bitcoin and not tech stocks and not gold. Without clear rules, capital hesitates even when it agrees with you, even when it thinks Bitcoin is a worthwhile asset. So what you've been watching for 10 months is not the market rejecting the debasement argument. It's the market pricing political risk more heavily than monetary risk, not to mention being crowded out by the AI trade. Those are different things, and only one of them is permanent.
The jobs report is important because it changes the equation far beyond employment itself. What looked like a resilient labor market suddenly looks considerably weaker once revisions are included, while the falling unemployment rate becomes much less reassuring when people are leaving the workforce rather than finding jobs. And that is why Consorti sees the market's reaction as something bigger than a simple response to one disappointing jobs report. Gold surged, equities ripped higher, and the dollar weakened as investors began pricing in a very different monetary environment. Capital started moving toward assets that can benefit when confidence in the purchasing power of fiat money deteriorates. In Consorti's framework, that is the debasement trade, and Bitcoin's failure to immediately participate is one of the biggest mysteries of this entire market. But this is where the Bitcoin story gets particularly interesting. If the macro environment is becoming more supportive of hard assets, why hasn't Bitcoin behaved like gold? Consorti's answer is that the thesis hasn't necessarily failed, the marginal buyer has changed. Gold can be bought by central banks without waiting for Washington to provide regulatory clarity. Bitcoin's marginal buyer increasingly sits inside the regulated financial system, where political and regulatory uncertainty can delay capital even when institutions already believe the asset has value. And now we get to the real test. If four events that should have produced significant downside instead produced resilience, something had to absorb that selling. Consorti believes the answer can be found in ETF, flows, institutional positioning, long-term holder behavior, and the migration of Bitcoin from vulnerable self-custody into regulated and more secure forms of ownership. That may be the clue to understanding what comes next.
Here's the part I think almost nobody has priced in, and it has nothing to do with Washington and nothing to do with the Federal Reserve. I told you 4 things happened in the last 10 days that should have taken this market lower. I want to go back and actually score them because the scoreboard is the whole argument. Michael Saylor's company, Strategy, sold 7,000 Bitcoin, the single largest corporate holder on the planet, selling into the most illiquid, low-volume month of the year, and they have paused new purchases for weeks while they build a $4 billion cash reserve. But Bitcoin's price went up. The cold card vulnerability drained roughly $150 million out of cold storage wallets and did real damage to people who did everything right. Some of you watching this video right now lost a lot of money. The worst self-custody event in years, and the price went up. And the spam debate produced an actual chain split on the Bitcoin blockchain over the weekend. Bitcoin literally split in 2, and the price went up. And finally, the Clarity Act died for now, and Bitcoin went up on the news all the way to $65,500. Any one of those takes 10% off of this market at any other point in the last 3 years. But Bitcoin managed to absorb all 4 and actually come out higher than it was at the start. So why is that? Here is what was actually happening underneath those headlines and why Bitcoin held so steady. In the same week as the cold card breach, American spot Bitcoin ETFs took in $853 million, which is the best week since April. BlackRock's fund alone took roughly $693 million of it. Money did not run out of Bitcoin during the worst self-custody event in years. It moves from self-custody into regulated vehicles, and it went in bigger because the price went up. And BlackRock said this out loud on Bloomberg last week. Listen to how they describe their own investor base right now. Take a listen.
Bitcoin has come down, and the ETFs track the price of Bitcoin going down. And there are a lot of people who came in maybe at 100,000 or 110. They're underwater. You're probably the guy who gets the phone calls. You're probably the guy who has to talk to them if they're like, hey, what's going on here? How is that going? How committed are they? Or are they starting to get shaky now that we've been around 65 for a while?
Well, what we've seen consistently through these 2.5 years is that the ETF investor base tends to be more of a fundamental long-term buy and hold type segment. And that's continued to be exhibited through this downturn. And, everybody who comes into Bitcoin hopefully understands that it's a volatile asset. It's always been a volatile asset, right? There have been now 5 major boom and bust cycles. Each time the cycle ends significantly higher than the prior one, but with a bumpy ride along the way. And so it's been the case in this one as well. So I think that we've seen sentiment turn in a noticeable but subtle way the last month or so. You've seen Bitcoin decouple from equities starting earlier in the year. For a while, that was hurting Bitcoin because equities, particularly AI, were roaring and Bitcoin was kind of flat to down. Then in July, when AI had the huge pullback, Bitcoin outperformed significantly. That decoupling is healthy because it's part of the thesis for a lot of people around Bitcoin as a diversifier and potentially a hedge against some of the left tail risks that exist elsewhere in the portfolio.
That is the largest asset manager in the world saying that their Bitcoin holders are not selling despite a 50% drawdown. And there's even more to this. Hedge funds on the CME just flipped net long Bitcoin futures. What on earth does that mean? Well, it means the suits are long Bitcoin, which is not something they typically are. That chart, as you can see, has been red for years, and it structurally should be because by design, most institutions are short Bitcoin. But guess what? For the first time in a very long time, they went long, which tells you everything you need to know about where Bitcoin is probably going next. And over 210,000 coins moved off of long-term holder wallets in the last week. Historically, distribution of that size shows up at tops, not bottoms, and Bitcoin did not make a new low. So this isn't selling, this is a migration event. Coins are moving into more secure storage and ETFs, and the market ate all of it. The people who were spooked by what happened with the cold card hack didn't choose to sell their Bitcoin, but move it. And that tells you everything you need to know about how the market perceives where Bitcoin is going from here. And underneath all of it, the cost basis math is not even close. The average long-term holder in this market sits on a cost basis around $49,300 roughly 30% below the current price. That cohort is not underwater, and they are not being forced to sell. They're not going anywhere. The pressure is concentrated entirely on short-term holders, those people who've bought Bitcoin over the last 155 days, whose average cost basis is about $67,500 and who've been underwater for about 3 months.
The most important takeaway from Consorti's analysis isn't that Bitcoin has suddenly become risk-free. It is almost the opposite. Bitcoin remains caught between two forces, a macro environment that is increasingly favorable to scarce assets, and a market structure that still has a significant amount of unresolved pressure sitting above the current price. Short-term holders are underwater, regulatory uncertainty remains a problem, and Bitcoin has spent months proving that being right about the long-term thesis doesn't necessarily mean being right about the timing. But something has changed underneath the surface. The market is demonstrating an ability to absorb shocks that would previously have triggered much larger sell-offs. That matters. When an asset stops falling despite increasingly negative headlines, the question eventually changes from what could make it fall to who is absorbing the selling. And right now, that answer appears increasingly connected to regulated capital, ETFs, and institutional investors rather than the speculative retail flows that dominated earlier cycles. That creates a very different opportunity set for investors. The preparation shouldn't begin after Bitcoin breaks out and the headlines become euphoric. By then, the market will already have repriced the information. The more interesting opportunity is in identifying the infrastructure and assets that benefit from the next stage of institutional adoption, Bitcoin exposure itself. Regulated investment vehicles, custody infrastructure, financial platforms built around digital assets, and where the risk profile makes sense, crypto networks and companies positioned to capture the next wave of capital. The key is understanding that not every cryptocurrency will benefit equally. The next phase is likely to reward liquidity, adoption, regulatory access, and genuine utility far more than simple speculation. So Bitcoin may not be completely out of the woods. In fact, Consorti's framework suggests that the real confirmation comes when the market clears the short-term holder pressure, Bitcoin moves decisively back above the cost basis of recent buyers, institutional demand broadens, and the marginal buyer no longer hesitates because of regulatory or political uncertainty. Until then, resilience is encouraging, but it isn't the same thing as confirmation. The market is giving investors a signal. The question is whether they're paying enough attention to recognize it before everyone else does. If you found this analysis useful, hit the like button, subscribe to the channel. Share this video with someone watching the Bitcoin market, and turn on notifications so you don't miss our next breakdown. Thanks for watching, and I'll see you in the next one.